Welcome, my friends. If you follow the financial news, you probably know that SPACs have been all the rage. SPAC is an acronym that stands for Special Purpose Acquisition Company. It is a type of company that is formed with the purpose of raising capital. It does this through an initial public offering, IPO. The intention of using that capital to acquire or merge with an existing private company and take it public. In other words, a SPAC is a shell company. It is created for the specific purpose of merging with or acquiring an existing private company. SPACs experienced a dramatic rise in popularity for about 5 years. But, in the past year, there has been a wave of bankruptcies and liquidations. What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. SPACs are also known as blank check companies. They typically have no operations or revenue at the time of their IPO. Instead, they raise funds from investors through the sale of units. This typically consists of one share of common stock and a fraction of a warrant to purchase additional shares at a later date. The funds raised from the IPO are held in a trust. That continues until the SPAC identifies a target company to merge with or acquire. Once a suitable target is identified, the SPAC will negotiate the terms of the merger or acquisition. The next step is for the SPAC and the target company will merge or be acquired. At that point, the combined entity will become a publicly traded company. SPACs have become increasingly popular in recent years. Some might have called it a SPAC fad. Some investors speculated that they provide an alternative way for private companies to go public. This is seen as a way to sidestep having to go through the traditional IPO process. However, they are also subject to a number of risks and uncertainties. But, investors should carefully evaluate the risks and potential rewards before investing in a SPAC. Because there have been cases of SPAC bankruptcies or liquidations. While SPACs are designed to merge with or acquire a private company and take it public. Not all SPACs are successful in doing what they set out to do. Some SPACs may struggle to find a target company to merge with or acquire. Or they may encounter other challenges that prevent them from completing a successful transaction. In some cases, a SPAC may have to return the funds raised in its IPO to investors. That normally happens if it is unable to identify a suitable target company within a specified period of time. This is known as a SPAC liquidation. In other cases, a SPAC may acquire a target company that later runs into financial difficulties. That normally leads the combined company's bankruptcy. For example, in 2020, electric truck maker Lordstown Motors merged with a SPAC called Diamond Peak Holdings. But the combined company later faced financial challenges that raised concerns about the company's viability. In 2021, Lordstown Motors announced that it was running low on cash. It told investors that it could go out of business if it did not raise additional funds. The Great SPAC crash basically ended 2022 in dramatic fashion. December witnessed a record flurry of liquidations. Lots of shareholders cashed out of the speculative investing industry for good. That included at least 80 special purpose acquisition companies. These companies raised $24 billion in total. And they face a wall of investor meetings. These meetings will give investors the chance to bail. That comes out ahead of a new U.S. tax that could hurt their returns. At least 32 SPACs holding roughly $18 billion are looking to close up shop. They could return capital over the coming 2.5 weeks. The latest headache for the blank check industry is a potential 1% excise levy. This new law could affect stock repurchases and buybacks. It is part of President Joe Biden's Inflation Reduction Act. And if you follow this channel, you know that the Federal Reserve is aggressively raising interest rates. That is resulting in falling share prices. And this is darkening the climate for acquisitions and mergers. It also puts companies with weak balance sheets in danger. SPACs have blamed the excise tax in filings related to accelerated liquidations since October. For firms that went public, an astonishing 96% of shareholders elected to redeem their stock on average. That's on pace for a record spate of redemptions. The combination of incredibly high redemption rates coupled with a virtually non-existent PIPE market makes it really tricky, said Keith Townsend, a partner in King & Spalding's capital markets practice. There is a financing avenue known as private investment in public equity that has traditionally backstopped a number of SPAC deals, Townsend continued. It all threatens to quicken the SPAC industry's collapse. This might happen at a rate that's faster than even its biggest detractors predicted just months ago. This is quite a reversal from the cheap money era that created more than 900 firms since 2019. SPACs are known as blank checks because they raise money in IPOs. They all had plans to merge with an unidentified company. They give themselves a short window to buy something or return the cash to investors. And shareholders have the ability to redeem their investment if they don't like the deal. Management teams can get short extensions to find and close deals. But they usually have to get shareholder approval and pay them to do it. Now, rampant redemption rates are hitting the SPAC industry. And it is hindering the industry's ability to get deals done. That means that firms are left with far less money than they initially expected. Meanwhile, there is a new tax threat. It is all part of President Biden's sweeping tax, climate and health legislation. The new law has pushed dozens of blank check sponsors to liquidate early. Many are simply choosing to give investors a chance to get out ahead of the law's implementation. SPACs were ensnared in the law's effort to rein in the frenzied pace of share repurchases. Share buybacks are a key move that public companies use to help boost their value. Many companies would rather invest the extra revenue in the business or paying higher dividends. Other types of shares, such as preferred stock with built-in redemption features, also appear to have been hit by the new law, which goes into effect in 2023. And things could get even worse. More than 50 SPACs with almost $15 billion in cash. They are seeking investor approval for additional time to complete a deal in the coming weeks. The companies have scheduled votes that also give holders the opportunity to take their money back. While bankruptcies and liquidations are not unique to SPACs, they do underscore the importance of carefully evaluating the risks and potential rewards of investing in a SPAC. Investors should conduct thorough due diligence on both the SPAC and the target company before deciding to invest in a SPAC. SPACs have gained a lot of popularity in recent years, with many high-profile companies going public through this route. However, there have been some concerns about the sustainability of this trend. In particular, some analysts have raised questions about the quality of companies going public via SPACs, and the potential for a bubble in the SPAC market.